Gold just crossed a line that changes the conversation, not because the number is magical, but because the psychology around that number is. $5,000 an ounce isn't a headline, it's a signal. It's the kind of price that forces institutions, governments, and everyday savers to ask the same uncomfortable question at the same time. What is stability worth now? Let that sink in. Because when gold is drifting at familiar levels, it gets treated like a side character, a hedge, a nice to have, something that sits quietly in a portfolio and rarely makes the news. But when gold surges into a new price regime and holds attention there, it stops being a trade and starts behaving like a verdict on the system behind the currency. And here's what needs to be understood. Gold doesn't move like this for one reason. It moves like this when multiple pressures stack together, and then, suddenly, the market stops arguing about them and starts pricing them. A reset doesn't arrive with sirens. A reset arrives when old assumptions stop working smoothly, when risk can't be diversified away the way it used to be, when credibility costs more, when the world quietly shifts from growth at all costs to resilience at any cost. That's what an economic reset looks like. Now, before going deeper, zoom in on the mechanics because the mechanics explain why a surge can become massive. Gold is priced through two connected worlds. There's the spot world, the headline price for immediate delivery. And there's the futures world, contracts that trade on major exchanges, where enormous exposure can be expressed quickly with leverage. In calm conditions, those worlds stay stitched together. Arbitrage keeps futures and physical aligned, and price discovery flows smoothly. In stressed conditions, that stitching stretches. And when it stretches, words start showing up that most people ignore until it's too late. Premiums, delivery, registered inventory, backwardation, cash settlement. A premium is the extra amount paid above the headline price to get real metal in a specific form, in a specific place, right now. Registered inventory, in exchange terms, is metal that's available for delivery against certain futures contracts under the rules. Backwardation is when near-term prices rise above longer-dated prices, a sign the market wants the real thing now, not later. Contango is the opposite, when future prices are higher than spot, often reflecting the cost of storage and financing. And cash settlement is simple. A contract closes in cash rather than metal. None of these concepts are scary on their own, but when they start mattering at the same time, that's when a pricing system begins to show stress. That's when gold stops behaving like a normal asset and starts behaving like insurance people suddenly want, all at once. And that all at once part is the key. Gold supply is slow. Mines don't double output just because price is higher. Recycling increases when people feel incentivized to sell, but it doesn't appear instantly. Supply is sticky. Demand is not. Demand can turn on in a week or in a weekend. A central bank can reallocate reserves. A fund can rebalance. A risk committee can change hedging rules. A wave of investors can decide confidence has a price. That mismatch, fast demand, slow supply, is how a surge becomes massive. Now connect this to history for a moment, because history explains the emotional rhythm of gold moves. In 1971, the modern monetary era shifted when the direct convertibility of the US dollar into gold ended, a defining break in how the world thinks about money. The system kept functioning, but the anchor changed. In 1979 and 1980, gold's price surge reflected inflation pressure and credibility strain. And it didn't rise politely. It spiked, corrected, spiked again, and burned the idea into the public mind that gold wakes up when trust gets tested. In 2008, gold initially fell during the liquidity scramble, because in a true cash panic, everything can get sold. And then gold strengthened as the scale of the policy response reshaped the risk landscape. In March 2020, a similar rhythm appeared. Stress first, then a powerful move as uncertainty, stimulus, and monetary expansion reset expectations. Think about that for a moment. Gold doesn't always rise during the first shock. but it tends to thrive when the response to the shock creates new questions. That's why the phrase economic reset 2026 matters. Because the reset isn't one event, it's a repricing of trust across time. Now, here's where conventional wisdom gets it completely wrong. The simplistic line is, gold rises because inflation rises. Sometimes that's true, but it's incomplete. Gold tends to do best when inflation is uncomfortable and the solution set is constrained, when tightening policy risks breaking something, when easing policy risks losing credibility, when the market starts demanding a higher premium for stability. That premium can come from real rates. It can come from currency volatility. It can come from geopolitical risk. It can come from fiscal uncertainty. It can come from reserve strategy. And gold is the one asset that sits at the intersection of all of it, because it has no counterparty promise attached. That's why central bank behavior matters so much here. Central banks don't buy gold because a chart looks pretty. Central banks buy gold because gold is neutral. No one else's liability, no one else's promise. Just metal, as a reserve asset. When official sector buying is persistent, it changes the floor under the market because it represents strategic demand rather than short-term speculation. Now add another layer, financial demand. When investors move into gold through highly liquid vehicles, flows can accelerate fast, and those flows don't just move price, they move psychology. Because rising gold attracts attention, attention attracts flows, flows tighten availability, and tight availability makes price more sensitive to marginal buying. That's reflexivity. It can drive price far beyond what reasonable models predict, until the market hits a point where leverage breaks, profit-taking hits, or policy signals shift. Which brings up the next crucial point, technical behavior. At extreme levels, charts matter not because they predict, but because they reveal where the crowd will react. Round numbers matter. 5,000 matters. Not because the metal cares, but because humans do. When price first clears a major round number, momentum can accelerate as skeptics are forced to adjust. Then, volatility spikes, because the same crowd that chased higher will panic on pullbacks. So the real question isn't whether gold is overbought. Overbought simply means the move has been fast. Fast moves either cool off sideways or correct violently. Both can happen. And this is where traps form. A surge can create the illusion of certainty, and certainty is what markets punish. So, the bearish case needs to be said clearly. A move like this can reverse hard. A stronger currency environment can pressure gold. Higher real yields can raise the opportunity cost of holding gold. Crowded positioning can create violent shakeouts. Margin changes in leveraged markets can force selling, and in a true liquidity crunch, even safe havens can be sold temporarily to raise cash. That possibility must be acknowledged, because gold isn't a straight line, it's a staircase with missing steps. Now, with the bearish case on the table, here's what those risks don't change. A reset environment is not about one day's price action, it's about the structure underneath. The structure is this. Uncertainty is being priced as persistent, not temporary. And when uncertainty is persistent, gold's role changes. Gold becomes the asset of optionality. Optionality means the ability to move without permission, without counterparty risk, without needing the right narrative to be true. That is why gold performs in regimes where trust is expensive. Now shift from theory to practical intelligence, because the most useful art is knowing what to watch. Watch the relationship between gold and real yields over time. Not one print, not 1 week, the trend. Watch whether financial flows into gold remain resilient during pullbacks, because resilient flows are a hallmark of regime shifts. Watch whether volatility spikes are being bought or sold, because repeated dip buying changes the market's character. Watch whether the conversation across markets starts treating gold as a signal rather than a commodity, because that narrative shift tends to happen near major turning points. And watch whether the world's institutions behave as if diversification is no longer optional, because that's the heartbeat of a reset. Now, what does all of this mean depending on the audience? For traders, the environment is opportunity and danger. Volatility can deliver huge moves quickly in both directions. Risk management matters more than conviction. Leverage cuts both ways, and late entries into parabolic moves can get punished even if the longer-term trend is intact. For long-term investors, the key is role clarity. Gold isn't a growth engine. Gold is often held as insurance against regime shifts, and regime shifts rarely announce themselves politely. If gold's surge is signaling a reset, then the question becomes allocation discipline, not adrenaline. For those focused on physical metal, the key is understanding that the headline price is only part of the story. Availability, premiums, and delivery conditions can matter during stressed periods. Physical gold is less about perfect timing and more about long-term purchasing power and optionality. For anyone new to gold, the most important thing is not to confuse a headline with a plan. A historic surge can pull attention into emotional decisions. Emotional decisions are expensive. Stop and let that sink in, because gold's biggest moves are often followed by the sharpest shakeouts. Now bring it home with 3 takeaways that cut through the noise. A gold surge into a new price regime is rarely about one story. It's about a convergence of pressures the market can't ignore. A reset environment is defined by the repricing of trust, and gold is the asset that tends to reflect that repricing early. And the most important skill isn't predicting tomorrow's tick. It's understanding the structure so decisions aren't driven by fear or euphoria. Verification matters. Independent research matters. Markets reward clarity and punish certainty. Full risk disclosure. Gold can be extremely volatile, especially after historic moves. Prices can reverse sharply. Leverage can magnify losses. No outcome is guaranteed. This is educational content, not financial advice, and any decision should match personal risk tolerance, time horizon, and careful due diligence. So here's the closing thought. $5,000 gold isn't just a number, it's a message that stability has a price, and the world is renegotiating what it's willing to pay. And if 2026 really is an economic reset, then gold's massive surge isn't the ending. It's the signal flare.